Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, December 18th, 2025. It's 10:16 a.m. Eastern Time as I'm starting the video, so we're about 45 minutes into the trading day. And here's what I wanted to cover in this one. As I often do, I'll start out with the equity markets. I want to say I think this pop that we have on this morning is fadeable. That's my opinion. I'll explain why here in the charts. We had, of course, softer than expected or cooler than expected CPI data. Market rallied on that. But here's what I'm going to do. We're going to start out. I'm just going to walk pretty quickly down the time frames that I cover on the NASDAQ 100. So I'm not going to do a super deep dive into the equity markets. That entails covering large caps, mid caps, so, the S&P 500, Wilshire, Russell 2000, and everything else. So we'll just kind of focus on the big one, NASDAQ 100, which again is typically my preferred index to trade. This is a monthly chart. We can go back as far as we can go. QQQ, one of the early ETFs, kicking off here when it first came out in right about the 1990, start around 1990, give or take. You can see right there. And this measures, you can see the corrections that we've had here along the way. And the two, what I call true or real bear markets that we had in the last, over a quarter century, really, since going back, since, the 70s was the last real bear market before that. So we had the dot-com bubble pop, about an 84% drop in the NASDAQ, and then the financial great recession, the financial crisis, about a 55% drop. Those were bear markets that played out as they usually do, over a year, about, average duration being about 15, 18 months. It all depends. And since then we had, COVID, of course. I call it Ursa Interruptus, my made-up term for a bear market that was interrupted by massive stimulus. And so, again, you can kind of eyeball the charts. Now, here, big picture is this. This is this is a potential long-term secular bull market uptrend line. This is the uptrend line that comes off the technically in the NASDAQ, it was the November '08 lows. Every other index, large, mid, small, S&P 500, they all bottomed in March of '09. So either way, that's the bottom right there. And so this is a trend line that it's absolutely one to watch for both swing traders, trend traders, investors. It is a trend line that, by my analysis, will be taken out probably next year. We'll see. And a lot has to be done before we get there. One of the best trend indicators that I like to use on both the S&P 500 and the NASDAQ 100 on this monthly chart is this 20-period exponential moving average. It just does a bang-up job, phenomenal job. It's that blue dashed line of defining bull and bear trends, and it's your simplest 401k indicator there is. You want to be out of the market or short when the NASDAQ 100 or the S&P is below that 20-month, long and strong when it's above it, and you buy pullbacks to it. It's the most simple and effective strategy that I know of. Again, if it's a 10, if there's a true rating scale 1 to 10, this is a 10. And I factor in two things on any indicator: simplicity and effectiveness. So you obviously get a 10. It can't be any more simple than that. And of course, it's a monthly chart, so you have to wait to the end of the month. And so that's it. So all these little red spikes below it that you see were just intra-month breaches. And since QQQ's traded, the only times that we've spent any significant time, more than just a single month whipsaw maybe, are the real bear markets. The dot-com bust, that 84% drop, financial crisis, 55% drop, and this bear market that we had back in 2022, where the NASDAQ fell, I think, 30-something%. Even COVID was a stick save where, again, of course, Ursa Interruptus. We were dropping down on track to take out that 20-month, but again, we saw stimulus, fiscal and monetary stimulus around the world, the likes of which have never been seen, not even close. So that kind of gave us this super jolt, kind of like the patient. My analogy is the patient came in the emergency room, not feeling well in the hospital, had the sniffles, and they got dosed with a massive amount of epinephrine. And that's what will happen. You'll get up and walk up the walls and crawl upside down on the ceiling like Reagan from The Exorcist if you get enough juice. And that's what the market did. And that's where we're at, guys. So that's a big one right there. And again, it's these divergences that are literally unprecedented, and it telegraphs where we're likely going in the years to come. And that's it. So first things first, that's the 20-month. Now, on a shorter term perspective, there's our primary uptrend line right there. I'm sorry, not primary. That's a secondary uptrend line. This is the big one right here, this yellow one. You want to buy pullbacks to that trend line. That's contained every pullback since the financial crisis. And when that goes, that will be a massive, significant technical event. Of course, when the 20 months go, and again, all that matters, the only thing that matters on this chart is how you close the end of the month, whether it be at the 30th or 31st or 27th or 28th if it's February. That's all that matters, is how that candle closes the end of the month. You can see we had a nice stick save right here recently in that last pullback here earlier this year, liquidation day from Trump. We kissed that trend line perfectly and stick saved it right back above that 20-month, which we took out intra-month. All right, so that's it. And then we've been basically back testing this smaller but still very significant uptrend line since. That's the uptrend line off these lows back here from that last bear market 38% drop. All right, so breakdown back test. And as I often said, if you followed me for a while, you've heard me say this, one of the problems on shorting a back test, once you break a trend line, it's always objective, but the problem with trend lines is they're dynamic, whether they're an uptrend line like this one or a downtrend line. Dynamic means they're coming in at different price levels as time goes on. So if you short the first back test, second, you can keep shorting and you start getting underwater. So what I like to see is an impulsive rejection. That's not really, we had an intra-month drop, but we closed back on the trend line. So once you see, there's an impulsive candle, there's an impulsive break. That's what I like to see on a sell signal, and that certainly worked there. We were short, not because of this. We shorted that whole move down, even game the bounces based on the 60-minute charts. That's got us in before, but that's just confirmed you were below that trend line. And we covered there on the April 6 lows for all the reasons stated at the time, both technical and, again, fundamental reasons I stated. So that's your biggest picture, guys. I don't update this often because they're really, there's not much to change every month, but I'll certainly highlight it if and when we get a impulsive rejection, or the bull case wants to see that, this trend line taken back, recovered, regained. Right now, we're simply back testing under it. And as I often say, I have a lot of made up, what I call yogiisms in the market. And one of those I always say, in life, patience is a virtue, and trading is an absolute necessity. Now, that doesn't mean if you shorted this, that you stay short all along, or if you shorted the back test. Again, just simply the back testing here isn't a reason, in my opinion, to short. We get down to the 60-minute charts and the daily charts for that. Let's step it down. That's enough on the weekly. So more recently, we did have sell signals based on the daily and weekly charts. We had first this trend line break. We had a bearish engulfing there, but then we went in and back tested. This was the uptrend line off the lows, same key April lows. And we put it back tested it right there, and then did get the impulsive rejection right there that I like to see. And that, again, on this weekly time frame. And it also gave us that bearish engulfing candle and a divergent high, just like you had back here. Yeah, that initial bearish engulfing candle, the NASDAQ 100 made a marginal new and still divergent high, put in a second bearish engulfing candle right there. That means the body of that candle engulfed the body of the previous candle, or candles. In this case, one candle. Gave you the drop, marked the high, it certainly worked there. And so far, that's it. So I started the video saying that I believe, at this point, it's still far from that all-in moment. I keep saying the same thing over and over, but I'll tell you where I think things are objective, and I still think it's objective to on a bounce back to resistance. Now, I'm going to get down to the shorter-term charts. They're pretty darn unclear. I'll be honest with you. We've been grinding around sideways, and what that does, it takes away some of the clarity and certainty and my confidence and exactly where to cover and add to long or short positions. All I can tell you is longs are objective on pullbacks to support, or you want to short, you wait for a break of support, and or you wait for a rally back into resistance on a short trade. So that's it. Just to summarize, that bearish engulfing still intact. So is that subsequent trendline break there, back test, this back test here, followed by a rejection. But as I've been saying now for 2 months and a week, we have to take out the October 10th lows. That's a key level for me. I'm going to step down to the daily charts and show you that. And that's right here. So ever since we put those lows in, I said that's the next step. Market must take those out to trigger the next wave down. So we zoomed down to this daily chart. We had the sell signal there on the break of the purple trend line, followed by a reversal, a back test of the purple trend line, and then hit of that first price target I gave you from these targets. When did I add these? I added it on November 17th. Yep, both of them, November 17th. And that was right, where did it go? We were already short based on the 60-minute charts, right over there. So we hit it, bounced off T1, again, which coincides with that October 10th lows, 589. Nothing more than the expected reaction off an initial target so far. And that's still the plan. That should take us back down for another test of the 200-day moving averages. And then I do have, as you saw on the week, oh no, I didn't show you on the weekly. If you're new to the site, these are my long-term targets for the NASDAQ 100. And it is a continuation, not a been in it the whole time trade, but a continuation of targets and a trade that was first laid out back here. We hit the first, second, and third target, and then for all the reasons stated on April 6th, the day of the lows after the big bloodbath from Trump's tariffs, we covered, and we also hit a price target, but also for that, again, many reasons, both fundamental and technical, covered all shorts, went to a long position. So this is again just a we hit third target, had a pretty healthy bounce, I'll say that, and then I gave you some new targets for those that have taken any of these recent sell signals as swing and trend trades that I just went over based on the weekly charts and daily charts. And so T1, T2, again, not to be confused with the targets that are on the shorter term charts. Those are for swing people trading those time frames. These are long-term trend trades, and that's it. So these remain. These targets have not changed. T3 has already been hit. So therefore, if we get down, start rolling down here, I'll let you know my thoughts at the time based on how the charts look. But if I had to say right now, if you put a gun to my head and said, okay, if we get down there and start to approach, are you going to cover and gain another bounce off T3 or not? I would say at this point in time, no, because it's already been hit. And so hold out for those next deeper targets. And I know it seems like the market will never go down again. That's what everyone's feeling is every time you have a rally. That's what everyone felt like right here. That's what everyone felt like right here. It's my style, guys. I'm going to tell you where I think things are going, whether they're going to go there or not. And then, as always, we're going to spread our bets. I'll try to get to the a few of the individual trade updates at the end of this video if there's time permitting. After this, I want to do an update on gold, silver, and the US dollar. All right, so that's that. There's your longer term targets based on the daily chart. Near term, swing targets. T1's already been hit. And let's step down to the messy 60. This is a 60-minute chart. Lots of annotations and stuff on here. For a while, we had a no shorting zone. Then we had some sell signals. Actually, the last couple trades we did were on this 15-minute chart. So we shorted there. So let's just look at the 15. We swung it down, hit our final target. Reverse, we had a divergent low, went long there. and we've come full circle. So this is why I'm starting the video out saying that I think, this nice healthy bounce. We're up almost 2% in the NASDAQ 100 today. There is some positive divergence that was put in recently at the low. That's a technical catalyst for this move. Again, the fundamental catalyst would be the CPI today. This is a really nice level. I can see this bounce carrying up anywhere from about right here. Like I said, you see a lot of lines on here, and I don't have a really solid. This is probably the best resistance that I have between where we are now and the recent highs right there. But remember, this is wash, rinse, repeat stuff. Divergent high gave us that. Divergent low gave us that. This is a divergent high. My take is that this is just the first leg down, followed by another move that could be, could stop at any point right now. Again, I'm going to give you additional supporting evidence as to why I think that here in a second. But like I said, it's kind of messy. And so what I've been saying for last few weeks now is I don't think it's time to be aggressively long or short. Whatever your opinion is, what I can tell you factually is that this is the NASDAQ 100. It's in this trading range, just like it was back here. And it's been slopping and chopping around sideways now for a couple months, but it's this. A lot of what I see here in the charts, negative divergence at that recent high. If we make another marginal new high, just like we did there, we just slightly punched out in the S&P 500, and I think on the NASDAQ it was about an equal high. And so if that happens too, my expectation will be no different than it was back there. I predicted that if we made a new high, marginal, it would be marginal, still divergent high, and then we drop and break down from that range and drop. And that's exactly what happened. And that's exactly my expectation right now. Now, if anything changes, I will let you know. But that's what we're looking at now. Let's go over a few of the key stocks before we move on. Nvidia, the daily, because we've been moving sideways, is getting, here, go back to the daily, a little sloppy. It's, look at this. What I can tell you on the daily is I did say we put in a divergent high recently. We're coming off that divergent high. Nvidia, the king of AI, the king of everything, is down about 17-18% from that divergent high. That's not really much for Nvidia, so I don't want to make that sound dramatic. When you look at a chart, that's just a run-of-the-mill counter trend move, even in a bull trend, in fact. So this is my weekly chart on Nvidia. And again, I don't think it's debatable that this is the single most important stock out there right now, being the poster child of the AI bubble, being the largest component of the S&P 500, the NASDAQ 100. So you have that mathematical weighting. We put in a divergent high there, just like the equity markets I gave you back then. Some long-term targets, this being my final target. And what happens? We hit my first target after the trend line break, broke this blue primary uptrend line. We swung it down, hit that first target again for all the reasons stated, including the video cover, go long off that low. And we've come full circle. The divergence that was in place at this high has not only not been negated. Negated would mean you take out. This was your previous high in the indicators. To negate or take out divergence, these indicators go up and they exceed the previous high, and then you no longer have it. So what I call a reset. So we had a divergent high there. That divergence was reset after, during this bull run up here. But this simply is an extension of that previous divergent high, meaning it's much larger. And typically there is no set formula or rule, but generally the bigger the divergence, the bigger the ensuing trend change. And so that would project down. We already hit my first target, so I have very little, if any, desire to cover if and when we get there again. That would increase the odds we're going to go down to my second, third, and ultimately fourth targets once this divergence plays out. What do we need to get there? Well, you can see a little purple trend line. This is a kind of support in this, this is where Nvidia is pulled back to. And we're trading today where we were back here, which is now 5 months ago. So Nvidia isn't going down. It's not going up. Bulls will say, those that look at things the glass half full will say, oh, that's just high-level consolidation that helps to work off the overbought conditions and provide the fuel for the next leg up. Maybe so. We had some of that here, but again, within here, this is a weekly chart. We were able to thread the needle, and that's what we'll do here. So I don't have a very, right now, strong opinion on the very near term direction. But as I said, if you want a level to watch, that purple line, that should break this low right here from September 5th. That will probably do the trick, and then you have your 200-day moving averages just below, also 40 weeks. So let me go to a few other stocks. Apple. Apple is I put it out here as a short trade back here, and it's probably, where did we short it? I guess probably here on that break. I'm trying to remember. I gave you 3 targets, and when it went sideways, I had a stop, which before it was hit, it was initially a stop just above recently a little bit above that bearish engulf. I put a red line here. Then I told you back at the time, I changed it to a weekly closing basis. And so far we haven't closed. This was all intra-week stuff. We fell back down below. And so that stop hasn't been hit. Again, as I say often, in trading, patience is a must. And so if you're in it, you're back maybe slightly profitable, but you can see I have a blue line here at about 266.78. That's nice support, and unless the markets break those October lows, you're probably not going to see Apple do much. So if you want to know my take on it now, better fish to fry at this point in time. If you're in it, just stick to your trading plan, whatever your trading plan is. It's so far the official trade is a stop on a weekly close above that. That has not yet been violated. Alphabet, it's interesting. It's right on here. Let me see if I have the other share class. You can see the trend line better. GOGL is Class A shares. This is there's the uptrend line. So I would suggest set a price alert, replicate that trend line, use log scaling. That's critical. Your charts are not going to match mine. And in my opinion, you're doing yourself a disservice if you're using a default setting in a charting platform of arithmetic, aka linear scaling. Log scaling is an absolute must, in my opinion, on trading, especially longer term time frames or any securities that have a pretty good differential between the price at the low end of the scale. In this case, Alphabet about 140 here and about 340 here. You're going to just have a distorted chart that makes no sense if you're using linear scaling. Log scaling puts all these candles, and it equalizes the move in percentage terms, which is all that really matters, not the dollar terms. So big difference when you have a $10 stock and it goes up $1, that's a 10% move. When that stock grows up to $100, that $1 move is now only 1%. So log scaling fixes that. So there's a line right there again. We're above that uptrend line right now, obviously. So that's Alphabet, and there's the trend line there. And I had to adjust it on this one. All right, so that needs to break. Microsoft, it's testing the 200-day moving averages. These are key moving averages for many stocks. I put up an exponential and a simple. That's the blue and red lines. And it's simple, just like I started the video showing you on the long term when the S&P 500 and NASDAQ are above their 20-month exponential moving averages. You're long and strong. When they're below it, you're short or out of the market. Again, it depends stock to stock, index to index, but typically your tech stocks and tech heavy indexes like the NASDAQ 100 and even the S&P 500, they just behave so well to the 200s. In other words, the trend is bullish when you're above them. Not only that, but you buy pullbacks to them. And I put both up, as I often say, and the reason is simple. Probably half the traders out there like simple moving averages, half the traders like exponential. Therefore, I look at them both because sometimes they buy the exponential and sometimes they buy pullbacks to the simple, which they've done here in the last couple weeks, right? Easy stuff. And so you buy till stop once they're taken out. Once they're taken out, you go in reverse. You short rallies back to them. Once they're recovered, you cover your shorts and you're long again. Again, that is not a standalone trading style. It's something I factor in. So when you see more and more of these leading stocks lose their 200s, chances are the index, if it hasn't done so, will ultimately break below. Right now, we have the majority above. A couple are back testing from below. I think Meta right now. Let me get to that. So just wanted to point out, where we're at. So you can set an alert, at least on this platform, you can set a price alert to trigger if the 200-day is taken out. Now what happens, intraday, you're going to get alerts. You're going to punch through there. They're going to, they're going to take brief little intraday runs or single 1-2-day closes. What you want to see is the 200s clearly lost. Once they're clearly lost, then you have a trend in which you can short back test to, or cover those shorts if other things confirm. All right, Amazon. Let's turn on the lines here. Amazon, let's turn them off again. Here it is. Took back the 200s right here after it was in a bear market. This is a great example. There's a lot, almost all the things do this. Lost the 200s right here after holding them in a bull market, bull trend. Lost them. If you missed that short entry, you had gifts. These were Santa came early back then. It was late, I should say. That was January. And I highlighted these at the time in the market too. Those were all your rallies back to the 200s. So it was printing money. If you were short, cover your shorts based on other things, 60-minute charts, divergences. If you're an active trader, swing it long back up to the 200s, reshort. And then, of course, now it was positive. You could see it all here. Positive divergences tell you to start, hey, you're not going to go down forever. This is when you want to start getting long, covering shorts, and getting bullish. And that was it in the beginning of, right in January 2023. Made a very unambiguous post. Full long, hard long, overweighting the NASDAQ 100 with my two top picks being, I believe it was Apple and Amazon at the time. They all looked like this. It was just a very clear time to get bullish and long, even though the rest of the world thought, the sky was falling because we were at the, throws, down there at the bear market was very much intact. But again, the charts said we were going to turn around and reverse. All right, so that's it. I just wanted to point out how well in a trend, and then you entered a bull trend, and they bought the 200 simple. There was a little whipsaw, and this is why I do these long-winded videos, because if you only trade Amazon in a vacuum, you would have shorted that. However, as I covered, I believe back then at the time, there were the majority of other stocks in there, the leading stocks were hitting or bouncing off either the 200 days or other support levels. So that was a breakdown that I wouldn't have shorted at the time if everything else was at support. One of the Mag 7 or 8, 9, 10 stocks isn't going to take the whole market down or the rest of them. And so here you took it out, back tested. We had its own little bear market. Amazon, that whole drop was about 35%. Lost. It doesn't look like it, but this is one of the world's largest companies. Lost a third of its value in that drop. And then look, back above. So simple stuff. All right. I don't want to beat a dead horse, but these are the things I look at on a day-to-day basis. And just know that a lot of these market-leading stocks are in close proximity right now. Again, most are above them. That makes it bullish. That keeps that strategy. If you are a glass half full guy or gal that sees, new highs into, well into 2026, if you're not buying Amazon here, then when do you buy it? You buy these pullbacks. Likewise, if you're a glass half empty guy or gal, think hammer's gonna come down on this market sometime, this end, between now and the end of the year, maybe first quarter next year, then you position and wait and watch for Amazon to break and lose the 200s, and then you will short it or short the kickbacks to it, right? Again, only if you make a case that the majority of other market-leading stocks, you can also make a objective case to short. If not, your Amazon's only going to go so far down without the rest of the lot, meaning Nvidia, Apple, Alphabet, Meta, Broadcom, Tesla, and the likes, right? Okay, lines back on. Remember, we're coming off a divergent high right there. Just like we came off a divergent high there, just like we came off a divergent high there, and need to break those. And again, I'm not going to go on all time frames on these, but if I do, it's the same story. All these market leading stocks are singing the same song that the NASDAQ 100 is. Massive divergences building that continue to build, that are really an extension of the divergences that we had back here, right? That was a divergent high, covered it ad nauseum back at the time. That's when the stock dropped. What was that drop? Was that what was this one here? Was that the 56? That's cut in half. Again, doesn't look like it on log scaling, but that's that drop. 50% drop based on technicals at the time. And these lines just disappear, some of them. Again, we had a relatively small divergent high. This time around, the divergences really have been growing from that point. And if you want to say, that's too long, you still have new divergences here as well on the weekly chart. And then there's your primary uptrend line right there. So when these break, you're talking a bear market that I hear very few, if any, even out there right now, as far as, you know, pundits say march out on Bubble TV, CNBC, and Bloomberg can see coming. But to me, it's clear as my hand in front of my face. It's a matter of time. And again, I'll be talking about the same thing a year from now if the technicals look the same and we hold that trend line. That until these trend lines go, these long-term primary trend lines, you're not going to have that 50% plus drop in the NASDAQ 100. But when they come, when you see stocks like Amazon, Nvidia, Apple all breaking those, yeah, then it's going to get ugly if you're long, or very profitable if you're short. And until then, I just can't make a case to get aggressively long on these guys. I mean, if 401k indicators are saying still long, but if you came into money today, would you put it all in the market right now? I wouldn't put your money in the market right now. Long, that's just me. I'd rather have it in cash, sitting ready to go. Or is this video is not going to cover dozens and dozens of individual stocks, commodities, treasury bonds, other ideas, both long and short. Because when you have that sideways trend that we've been in on the S&P 500 lately, in the NASDAQ 100, it's a stock picker's market all day long. It's been a very profitable market to trade. You just have to be in out, long, short, and go off the chart. So let me finish this up. Meta. I'll just stick with the daily time frame. Meta did put in, I just turned off my light. It was a divergent high. Meta took out the 200s and has been back testing them. So this one is one of the few, but one to watch. Now, if it takes it back, it's hard to spin as anything but bullish, right? Last time it went under the 200s, spent about this much time, took them back there. If you bought that recovery above the 200s, you made about 37% over the next few months, right? However, last time back here when you lost the 200s, you checked them, kept trying to recover, and when it couldn't do it, once it clearly lost them from that last back test, the stock dropped 74%. Let me repeat, 74% drop. Your $1 million would now be worth about $250,000. You would have lost $750,000 if you had $1 million. Whatever your number is, 100,000 would then be worth $25,000 if you didn't heed that, or you were a flexible trader and you shorted it. And again, I know I'm playing the high to low game. I'm playing from that point. I'm just trying to show you, where we're at right now technically, and so. I have to do this when this market has been very resilient. I feel like it, I need to explain my outlook. And again, as far as positioning goes, I've been very clear. It is not an aggressive all-in long or short moment. In fact, better fish to fry, probably be just as well in hindsight, not having anything in for the last few weeks because we're just going back and forth. But speaking to the longer-term swing and trend trader, when I say, and in my own accounts where I have, what I call starter short positions based on the sell signals I started earlier in the video, and those are still profitable from where we got the sell signals on the NASDAQ 100 recently. All right, a couple more. Broadcom. I want to talk on Broadcom. This one's been triggering alerts left and right for me lately, but because it's been moving chopping around. I know this is a busy board. What I mean by that, I have a lot of old lines and targets, but the most important levels on here, I see this to me, I've had this, that's why it's colored up yellow. It's more significant. About 324, I have it at 324.39. There's that key October 10th low. You've heard me talk about those quite a bit. There's a big old gap in there. And here, let's turn off all the lines and show you something here. You have the, I love this indicator. It's always on my charts. Sometimes I have it tuned down, the volume at price histogram that shows you how much buying was taking place at a certain price. So down on the bottom, that's your regular volume, right? Each day. This is volume at each price. And so you can use these as to define support and resistance levels. And so you have that huge bar there, and it shows it's reflective because we've been in this trading range. So once that level is clearly taken out, and of course you have a big gap here, so that's why the volume is very thin there. During a gap, no trades occur. Now there were trades before there in that gap range, but that's why you have a few bars. Either way, what happens once you tend to break those support levels, which also meshes with the price levels I gave you, price support, you tend to go down. And when I look at this, there's a big void. This is where the next big support comes in at the volume price histogram, down around here, about 246. So I just wanted to share that with you, and let me turn that off, make it muted again. So I keep it on my charts just so I can see it and it's not getting in the way. And when I look at big picture, and remember Broadcom, this is one of the mag 7, 8, 10, whatever you want to call it. It's the technicals are clear to me. It's in a bull. This is their secular bull market uptrend line, very well defined. And then every now and then you put in a divergent high, and this was a correction that lasted years. You went down. It was mostly in a time, more so in price, but that was, I'm sure if I measured that out, very well into the double digit drop. Same here, same there, same there, same there. Last divergent high we had was right here. The stock fell 46%. That's something else there. 46% drop. So the stock got cut in half. And the only difference between then and now is that same divergence leading up to that 46% drop right here has only grown larger, indicating that when this one finally goes, it's got a much bigger drop coming. And again, Broadcom is one of the leading stocks, leading chip makers. We all know Broadcom. So, all right, let's move on. Tesla. Here's my weekly chart on Tesla. Divergent high. Tesla, the trends are powerful. 75% drop. The next divergent high I put in recently from same levels it's at now, we dropped 56%. And no change in the technicals, except the divergence just gets bigger and bigger. Same divergence is getting bigger and bigger. And you have a primary uptrend line here that comes off the 2019 lows in Tesla. That's also a pullback target if you're long, or I'm sorry, if you're a short seller, or if and when that breaks, that's a much more significant level. If and when that breaks. Okay, and on the daily chart, we have this series of divergent highs. Let me extend my line out. This one, so off that divergent high, we had about a 13% drop. That one gave us, I think it was 20, pop-up box says 18. Let me see, there to there is 20, almost 20%. And it's the same divergence that keeps getting bigger and bigger. And it's usually, not always, but usually that third strike that does a trick, that third divergent high in a series of divergences. And I probably should, I'll leave that trend line there. There's a little minor trend line there. So there's Tesla. And, it's really, I showed it to you on the weekly, but the divergence on the daily just carries through since all the way back here. And so, again, you have those smaller divergences right here, 1, 2, 3, or really it just carries from this point here. So now we have a roughly equal, slightly higher high, and that's just a bigger divergence again that shows better when you see it that far out on the weekly chart. All right, guys, let me do a couple individual stocks before we get to the metals. Oracle, I've given, there were several chart requests that I shared. People asking about where I thought Oracle was going after that. The market, they marched out the bull brigade in full swing that day. There was the biggest day Oracle had, I think, since the dot-com bubble. All this AI hype on it. And so at that point, someone asked where I thought it was going, so I called it down. Initially, I said, you're going to take it this level out. It's going to be a sell signal on 291.14, come down, backfill that gap. Here's the gaps, this right here. And so I had it that point going down to the bottom of the gap. Let's see what happened. Well, let me show you the next chart. And then I followed up again with a couple charts since, but that was it. So there was that gap backfill right there. That was my initial target. Then somebody asked again, and I highlighted here, back testing the 200-day moving averages. I don't have a position, but stated that my guess would be that it would get rejected on this back test of those beautiful 200-day moving averages and take us down to 179.36, and that's about as far down. And so let me show you where we're at now, because this is an actionable trade idea if you've been following that chart, and it also speaks to the market bouncing today. So that was it. So this was where was that first level I gave you? Hold on, I have to double check. This one, we were at 291.14. 291.14 right here. And so we've completed, that's it. If anything, I would cover that short. This was that final target. That's a 38% drop from the break of 291.14. On it down, we've come full circle, positive, aka bullish divergence. That's not a random level. I've had that level here since 2021. Believe it or not, I might have updated it, doing something, tweaked it recently this year. But it's a big old gap right there, reaction high, another gap right there, reaction high, reaction lows, and positive divergence. So if you swing any or all of that down short, or if you took that last short I gave you right there, I mean, that alone provided another 20% drop on that kickback rally. I would certainly consider either covering this short or setting a tight stop in case we do get a little uplift here. Now, longer term, stock looks done to me. That was a divergent high. That looks just like an initial wave down, really, a little counter trend kickback rally there. But again, rejected off the 200-day moving averages. So let's just look at history. Last time we did that there, we took the 200s out right here, and I'm trying to measure. I have to move to the right a little. From there, it dropped 25%. We took the 200s out right here, following that divergent high, and the stock dropped 31%. And all that's in a roaring, strongest bull market we've had pretty much in I believe in history now. If you look at the the larger secular bull market, and you remember my theory is based largely on, not exclusively, but very largely on the fact that a super solid case, in my opinion, can be made that we just finished a nearly 50-year secular bear market in interest rates and have embarked on early stages of a new secular bull market in interest rates, and that'll just flip the stock market's long-term returns upside down. In other words, probably looking at the start of a new secular bear market that can easily go for a decade or more. All right, so and then my point is that again, my point to that is these are all just bull market corrections, right? But they'll wipe you out if you're on the wrong side of them. 40-something% drops. The stock, corrects by a third to almost a half each time. It just has these quote-unquote corrections, and it's a longer ongoing bull market. There's your secular bull market uptrend line right there. And so if it visits that secular bull market uptrend line anytime soon, it's going to be about a 70% drop. You have to say, you know, if you're willing to ride that out, if you're a long-term bull in Oracle. All right, guys. We're going to cover a couple more stocks, and then I figured what I'll do. I'll just do gold and silver and GDX in the next video because I also wanted to cover the dollar. All right, so I covered Oracle, Broadcom, and on my notepad I wanted to also talk about SMCI. SMCI I call the Robin. If Nvidia is Batman, this is this little sidekick Robin, kind of a tell into data centers and all that. So we've had a lot of trades on this one in recent years. We'll call two major tops on this thing. Shorted the hell out. We've also had plenty of long trade ideas. The last previous official trade was stopped out. Shorted it, I think, God, where was it on the break of this trend line with a stop above 49. That was hit, but then I re-highlighted it here in a video as a new trade idea, giving you new targets right here. Total of 7 on the break of that, or it might have even been the back test. You can just, below this post, if you click on SMCI, on the links, the symbol tags down below, they're hyperlinks, and it'll bring you back. So just go look around this time, October, whatever, and you'll see that in the video. So we went down, and then I updated you more recently right here. I did BF, meaning bear flag, when it was starting to develop, and that's certainly what developed. This is what we call a bear flag continuation pattern, this being the flagpole or the impulsive move leading down to it. And I gave you the measured target. You put at the top. Actually, at the time when I did the last video, we hadn't broke down yet. So until you break down below the flag, you don't know the highest point. So you take the measured target, again, which is the flagpole, the distance from the high. You know, I need to, that line's a little long. Right there. Let me zero it in, tweak it for you. There it is. And you take that line and add it to the highest point of the bear flag before it breaks down, and that gives you your measured target. And you can see that comes right in a little shy of the bottom of my T6 target zone. So we already hit my first, second, third, and just yesterday, I was out yesterday afternoon. I told you I'm kind of in and out, vacation mode. I was with my wife and son yesterday, one of my kids, and that's it. So there was the breakdown, sell signal break below the flag. Now, bear flags tend to play out. If they're going to play out, the move coming out after you break down the flag, you want to see it start out impulsive. So far, check, check, check. We have all the checks we need right here. Now, doesn't guarantee it's going to play out. I'm just telling you it is playing out so far. And you tend to have a fairly unidirectional and equally impulsive move on the way down. So it would look something like this if it's going to play out. Now, I've seen plenty that don't play out. And I can tell you right now what would cause it. You know, let's say we have a Santa rally. Right now we have positive divergence, just like I gave you on Broadcom or Oracle, I'm sorry. So there is positive divergence. That could be the catalyst. And we're at support. Remember, this is T4, price target. That gives you a drop so far of profit on that one of about 44%. Okay, sorry, I had to take a phone call. That was my wife upstairs. Couldn't figure out how to turn the AC down. I got that whole smart home thing going, and she just can't figure it out. Anyway, all right. So yes, guys, that's 44% drop. We're very oversold. Positive divergence might not be a bad time to. An active trader could certainly cover, go long, game of bounce. To where, let's just see where, if this, rally in the market sticks. But if, the thing about positive divergence is if this is going to play out and if this stock is really topped and we're going down here, as I often say, it's bull bait, bull fodder. It'll, it looks and feels good, and bulls will step in and buy it. Like I did, support, expect a reaction there. So far, we have a reaction. I mean, it's up, a little bit from hitting that level yesterday. But what happens is just as it starts to look and feel and smell real good, right? You start getting a cup, they dump it, and that downtrend will continue. So as you can see here, when we had that initial leg down, there were only 2 green candles. My candles are set to show on the daily close. So We only had three green candles. That one was barely there. So that's what you most likely expect. And I'm going with that right now. I don't have enough evidence on the contrary to think this is going to be there. But I do this, guys. Remember, I do these videos and I point out objective entry points. And so if you are bullish, and I know some listen to my voice are, you think we're going to Santa rally, you think we're going to, Kramer's right, or whatever the crew on CNBC is telling you, and 2026 is a good year, the economy's strong, Trump told you so last night, all that good stuff that you want to hear, then you buy this one here. And listen, just in case you're saying, you're being a little sarcastic, Grant. No, I'm not. I'm serious. And you just put a stop a little below there because that's support. So if your point entry case for buying this is the bullish case I just made, very oversold, positive divergence at support, you buy it at support with a stop somewhat below, just like in the stock market. If you took the recent, again, in the beginning of the video, I highlighted several sell signals that we had on different things, candlestick reversal patterns, the bearish engulfings, trend line breaks, back tests. And then more recently, I gave you this partial rise strategy where you can short the S&P 500 here once we started rolling down. So your stop can be right there. It's super simple. And if this or those bearish engulfing candles play out, the thing is, this is not a little 15 or 5 minute chart trade. We're not looking to make 3-4% on a bounce on the Qs, or this would be a call for a major top. Or at least a major correction, something along these lines, right? So you're risking a relatively tiny amount of loss for the gain potential if that plays out. And the thing is, you just can't overthink it. You either take that or you don't. Have a trading plan, stick with that trading plan, unless something tells you otherwise or convinces you to change it. And as I often say, if you're new to the site, I'm going to repeat this, it bears repeating. One of the best things to develop in trading, since sliced bread, in my opinion, are OCO orders. One cancels the other. Sometimes a broker will call them OCA, one cancels another. It's the same thing. You short QQQ or SPY here. You put a stop loss here. You put your price target or targets down here, wherever they are. And you do that as an OCO order. And what that says, if it goes up here and you get stopped out, it'll automatically cancel that order. And if you go down here and your target's hit, it'll cancel the stop loss order. And what it does, it gives you discipline. Set it and forget it. Make sure you set it. Good to cancel. Don't do a day order. It's going to drop off at the end of the day. Good to cancel. And that most brokers, I think it's 90 days they'll give you, and you can renew the order at the end of the 90 days. I'm just seeing a support level there. I think I already have that on my other board. All right, that's it. I really don't think I have much more for you on the markets. Again, this is where we're at, and again, where we're at, we're in the winter doldrums, if you will, and that's it. So there's what SPY looks like. Let me just give you futures real quick for you futures traders. What's this? That's NQ. This is my NQ daily chart, daily candlesticks, 18 months of price history. If you're an NQ trader, we had this uptrend line that was a divergent high, breakdown back test. This will mesh with what I showed you. Also, this uptrend line here, same thing I showed you on the QQ daily chart. There was a breakdown. There was the October 10th lows. That's your big level. If you're an NQ trader, you need to see, if you're bearish or you're looking to go to a full short position, you want to see 24,370, we'll call it 24,370 taken out, right? I have it at 24,372.93, which is 24,373. There's your first target if and when that's taken out. If that happens, just keep this in mind. If this happens, it's kind of like that app you can get on your phone, IFTTT, if this then that, right? It's a, triggers one thing, triggers another. So if this happens, and we break down, we go here, and it happens anytime soon, it's going to further solidify sell signals and trend indicators, some of which have already flipped on the more significant weekly charts. And that's going to increase the odds then we're going to go down to my deeper targets. Just keep that in mind. But first things first, sometimes we hit my early targets and bounce. Sometimes we don't hit any targets. That's what stops are for. But there's your daily chart. What else I have for you? That's NG, natural gas. That's NQ. This is a hourly chart. Kind of my favorite swing trading time frame overall. That was a divergent high. We traded that. We had two targets back then. The futures have rolled, so the targets aren't marked. We hit both of my first and second targets on that one, cover there. Then we had that short there. I give it on the 15-minute chart. Ended that with that divergent low. And we've come full circle, and that's where I started the video, just to reiterate. That's why I think this bounce is shortable, because this was our most recent divergent high. No different from this divergent high, which was a little one, and all we were looking for. Remember, back then I was only looking for two targets I gave you, and we hit them both. Looking for a quick pullback. This one I gave you deeper targets, a total of 5, or I think it was. And this time around, we've come full circle. That was a divergent high, equal high with lower highs on the indicator, still divergent high. We've been walking lower since, stair-stepping lower. We did put in a divergent low here. It could carry us higher or not. Basically, I think or not. That's why I started the video telling you I think this is a shortable bounce up to. This would be a really nice level too if we can get all the way up there. Based on where we're at, the markets don't make it easy for the masses. But I'll make it easy for you. I think that's an objective shorting level. You may want to pause or not add there. If we got there, I'll tell you too, that's even bigger resistance. But again, recognize the market for what it is. We're in this sideways range, right? And ultimately, we're going to have to break down below that range or break out above it for the market to pick a new trend. This is the trend I think we're going to go. And when I have those sell signals that I started the video out with on the monthly, weekly, daily, that puts me, because I can sit here and all day long analyze the charts, make a bullish case, make a bearish case, and then ultimately we get locked up with paralysis by analysis, right? Where you don't want to do anything. And again, I don't think it's an all-in. Charts aren't super clear. I'm just giving you my preference, and that's where I think we're going. And if we start to, like I said, if we take out the October 10th lows, my confidence is going to go up quite a bit, and as will my positioning on the short side. Until then, spread your bets if you are engaged in the market right now. If you want to stand aside because it's the holidays, you're probably not even watching this video, but if so, yeah, just spread your bets. There's plenty of bullish stocks out there right now doing well. Again, the financials, until the financials break down, the market's going to go nowhere to the downside. I can tell you that, or very, very little limited. I'm talking about the tech stocks, the NASDAQ 100, even though they don't have financials. It's, the S&P, it's going to hold up, and it's going to hold the NASDAQ up. All right, I'm going to wrap it up here, get the video out to you guys, and I will follow up with one on the metals and miners for you. This has been Randy Finney with Right Side of the Chart. Have a great day.